Okay, so let's see and get your ideas for beating the street. Yes, it's time for a Beat the Street segment. And today we've got Ashwini Agarwal, co-founder and partner of Ashmore Investments Management India. Good morning. Today in the markets, you're seeing a gap down. We expected that with the kind of weak overnight report card from Wall Street. But the question is, earnings season has officially kicked off. You had TCS, the IT bellwether, come out with its numbers. Infosys is tomorrow. Delta Corp disappointing the street. So let's begin with earnings and your expectations from earnings for the fourth quarter. This quarter, are we likely to see downgrades? Have the markets already priced that in?
So, it's been widely accepted and expected that earnings for the March quarter are not going to be very good. I mean, you've had individual companies in the consumer space highlighting as how raw material prices have been high and consumer demand has been soft. Similarly, various other companies have spoken about rising raw material prices. On the other hand, for exporters, shipping constraints and high shipping rates continue. So for a large number of manufacturers in India catering to either the local markets or the overseas markets, they are contending with higher raw materials and higher costs of energy and higher costs of transportation. Having said this, when you look at the aggregate market and especially, say, Nifty earnings, you might not see a massive downgrade for the simple reason that if you look at the composition of the index, banking and financial space, IT services, the oil and gas pack and telecoms together make up nearly 2/3 of the index. And here, I don't think you're going to see a significant downgrade. Metals, you might see probably a little bit of an upgrade. So you add it all up and you might not see a significant downgrade, at least on the frontline Nifty earnings. When you drill deeper, of course, there are challenges and we'll have to contend with them as we go along.
Fair point. But Ashwini, when we talk about all of this, it's happening at the same time when you're seeing a really nice sectoral rotation, right? Power, defense, pockets of FMCG, metals. But IT just continues to underperform, which has been the star performer the last 2 years. Has it peaked out?
Great question. If you look at historical PE ratios or historical valuation ratios for IT services companies over a long period of time, going back 20 or 25 years, barring the early part of 2000, IT services have never been so expensive. And they've been a great place to hide for the simple reason that they had spectacular growth over the last 2 years when the outlook on pretty much everything else was a little hazy. Going ahead, valuations obviously are acting as a headwind, and so are costs for IT services companies. Attrition rates are high. You will have resuming of the travel costs and office reopening costs come in. But at the same time, demand remains very, very strong. I don't think there's any question about that. And if you look at the global macro backdrop and you want to pencil in higher inflation and possibly, India being a little bit behind the curve on the rate side, you might continue to see a strengthening of the dollar versus the rupee, and that might act as a tailwind. So notwithstanding the valuations comment, IT may remain a place to hide, though I would also caution that it is significantly overowned because, it's been a darling of the street for the last 2 years. So most portfolios have a lot of it already. So, it is a tricky one to call. My sense is that, you will continue to see earnings growth of 15% or thereabouts, ballpark, for the IT services companies over the next 2 years. And that's the kind of maximum return from the stock price one can expect. There is no room for re-rating. And if the dollar tailwind doesn't show up, there's probably downside ahead.
What do you do? I mean, is it more the bottom-up stories, the FMCG ones, wherein the devil is pretty much unknown? Do you bet on that now? I mean, going by how the stock markets have actually been pulling up ITC finally, or even a sporadic Britannia and Godrej consumer, that clearly seems to be the case.
Yes, I've been saying this, internally, and I'm happy to share it with you. I entered the market in 1992, and if you look at the BSE Sensex between 1993 and 2003, it went nowhere. Okay, compounded annual growth in the Sensex over this time period of a decade was 2%. Okay, it sounds hard to believe, but that's the truth. And at the same time, there were plenty of mutual funds that gave a compounded annual return of 23, 24% over this time period. What happened? What happened was that post the Harshad Mehta boom, the markets had become very, very expensive, especially the frontline names. And therefore, you had to generate alpha bottom up, looking at different ideas, different stories, new listings. IT became a new sector almost. Pharmaceuticals became a very important sector from being nothing at the start of that decade. And I see a similar story playing out. Valuations are expensive, and therefore, we can't expect much action in the Nifty, down 10%, up 10%, that kind of drama will probably continue. But you will have a lot of opportunities bottom up. And this is exactly the kind of market where professional money managers and astute investors should be able to find good ideas that they can work with.